I have a confession. I finally put the plug on my Robo-Advisor.
You did? But those are supposed to be the absolute easiest way for beginners to invest.
I know, but I just stopped putting money in.
You lost the motivation to invest?
Totally. I was supposed to add $500 a month, but I just couldn't do it anymore.
What changed your mind?
I looked under the hood at what I actually owned and realized I was paying a premium fee for a messy portfolio.
That is exactly why so many investors eventually leave robo-advisors. They realize the convenience fee is actually eating their future wealth.
We need to expose this trap.
Let's do it. Quick reminder, this is just our personal experience. This is for educational purposes, not official financial advice. Always do your own research. Let's get into it.
To be fair, when I first started, I had zero investing knowledge. I was actually invested in expensive mutual funds at my bank.
Oh, wow. What made you finally sell them?
I read the book Beat the Bank, realized how much wealth I was losing to that 2% fee, and sold everything.
That is a huge first step. So you moved the money to a robo-advisor instead?
Yes, I specifically chose Questwealth because their 0.25% fee was even lower than Wealthsimple. At the time, it felt like a massive win.
It is a massive win. Slashing your fees from 2% down to 0.25% is an incredible upgrade for a beginner. But then you kept learning.
Yeah, once I started learning how ETFs actually worked, I finally looked at what my robo-advisor was buying for me.
Let me guess. They had you in a dozen different funds to make it look incredibly complicated?
Yes, I opened my account and saw I owned fractional shares of 10 different ETFs.
10? That is classic. What did they have you holding?
Everything. EMXC, SPTM, ZCN.TO, plus 4 different fixed income and bond funds like Cash.TO and XBB.TO.
Wait, 4 different bond funds?
Yes, and I never even chose a low-risk profile.
That is incredibly frustrating. When you are young and in the wealth building phase, you need growth. Having a huge chunk of your portfolio sitting in fixed income acts like a permanent anchor on your gains.
Why would they split my money up like that?
It is an industry tactic called the illusion of complexity. If a robo-advisor just put all your money into one great all-in-one ETF, you would wonder why you are paying them a management fee.
So they make it look complicated, so I feel like I need them?
Exactly. They slice the pie into 10 tiny pieces to justify their fee. They want you to think it requires a complex algorithm to manage. But you could just buy one single index fund yourself and get the exact same global diversification.
Let's talk about that fee. When I started, I picked a robo-advisor that was actually cheaper than most. They only charged a 0.25% management fee.
That is true. Most of the big ones charge 0.5%, so 0.25% sounds like an incredible deal.
I know, it sounds like nothing. But once I did the math, it was a silent killer for my portfolio.
Because that 0.25% fee is charged on top of the regular ETF fees.
So if I buy an all-in-one ETF myself, my total fee is only around 0.2%. But with the robo-advisor, my total fee was closer to 0.45%.
Let's look at the actual math on your $500 a month over 30 years. Let's assume the stock market averages a 7% return. If you do it yourself with a 0.2% fee, your account grows to over $610,000.
Okay, and what if I leave it in the Robo-Advisor with the higher fee?
Your net return drops. After 30 years, you only have $580,000. You just paid the robot over $30,000.
$30,000 just for them to hold 10 different funds I didn't even want? That is exactly why I stopped contributing.
It is completely demoralizing. You are paying a $30,000 premium just to avoid logging in and clicking the buy button yourself once a month.
That leads to the biggest issue. I lost all my motivation.
Because of the fee drag?
Yes, every time I thought about transferring my $500, I thought about the fees.
You realized you were overpaying for a portfolio you didn't even want.
Yes, it made me not want to invest at all.
That is the trap nobody talks about. It becomes a black box. You log in, you have no idea what you own, you see the fees, and you just stop caring. But when you take control of your own money, that completely flips.
Moving it to a self-directed account changed everything.
Because now, every time you buy a share, you know exactly what you own. You know you are keeping 100% of your own growth. That empowers you to actually want to stick to your budget.
Now I actually want to invest my $500. So what should someone do if they feel stuck in a robo-advisor?
First, recognize that it is a great stepping stone. It gets you into the market. But once you realize you can do it yourself, it is time to make the switch.
I remember being terrified to move the money. I thought I was going to ruin my TFSA contribution room.
That is the number one fear holding people back. Beginners think they have to withdraw the money to their checking account and then redeposit it. Do not do that. If you withdraw it yourself, you lose that TFSA room until next year.
So how do you actually move it safely?
You do an institution-to-institution transfer. You open a self-directed TFSA at a zero-commission brokerage, and right inside their app, you can even request a transfer from chat.
But what happens to those 10 different ETFs I owned?
When you request the transfer, you choose an in-cash transfer. The Robo-Advisor will automatically sell all your fractional shares of bonds and emerging markets, turn it into cash, and send that cash directly to your new DIY account.
So no tax events and no CRA penalties?
Exactly. It all happens behind the scenes inside the TFSA umbrella.
Okay, so the cash finally arrives in my new account. What is the next step?
This is the crucial part where people mess up. The money arrives as cash. It is not invested yet. You have to physically log in, search for a ticker symbol, and click buy.
And that is when I just buy an all-in-one ETF?
Yes, a single fund like XEQT or VEQT holds the entire world in one ticker. No rebalancing, no calculating fractional shares across 10 different funds, and no 0.5% management fee.
But won't I miss the automatic investing from the Robo-Advisor? I love that my $500 just invested itself.
You don't have to lose that. Most modern zero-commission brokerages now have a recurring investment feature. You can set it up so every time your $500 paycheck hits, it automatically buys shares of your all-in-one ETF.
So I essentially built my own Robo-Advisor, but for free?
Pretty much. The DIY route is actually cleaner, cheaper, and faster. You are just cutting out the middleman and keeping more of your own money.
I am so glad I finally quit.
You took back control of your future wealth. Now, if you are moving your money and wondering what to actually buy, you need to avoid the biggest trap new investors fall into.
Do not just buy dividend ETFs.
Exactly. We just made a whole video breaking down exactly why selling VDY was the smartest move and why dividend investing can actually stunt your growth. Click the video on the screen right now to watch that next. And if this helped you out, a like really helps the channel. We will see you in the next one.